Welcome back to Alpha Recap. Thanks for joining us after the close. I'm glad you're here. Today, we're breaking down a patchwork market where tech and health led gains, while crypto and energy hit headwinds. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to unpack from today's tape. Some clear winners and a few risk areas that grabbed headlines.
All right, big picture first. Markets closed with a pretty distinct split. Technology and healthcare supplied upward momentum, while crypto, energy, and some utilities were under pressure. So, what really stands out here is...
I'd say the tech hardware angle and the clinical wins in healthcare were the dominant stories. They actually reinforced each other for growth-oriented sectors.
Let's start with tech, specifically AI hardware. SK Hynix began mass production of a 192GB LPDDR5X module aimed at NVIDIA-class servers. Ben, explain why that mattered today in plain language.
Sure. Memory density and bandwidth are the limiting factors for big AI models. More memory per module means systems can run larger models or do more in a single server, which reduces the number of separate machines companies need. So when SK Hynix moved to mass production, it was a signal that upstream supply was gearing up for more AI deployments down the line.
So, in other words, if memory keeps improving, companies can scale AI without stacking racks and racks of boxes.
Exactly. And analysts note that when these hardware cycles accelerate, related suppliers and cloud providers tend to show tighter correlations in revenue and order activity a few quarters later.
Right. And the other thing is, that also rippled into industrials and even finance, where people are piloting AI for operations and risk models. Healthcare was another outperformer. There was M&A activity like the Lilly tie-up and some strong CAR-T prevention data. What did those moves signal?
They suggested investors were rewarding event-driven, defensive growth, companies with clear clinical data, or bolt-on deals that shorten time to market. That kind of news tends to reduce perceived pipeline risk and can re-rate portions of the sector, even while drug pricing scrutiny continues.
Honestly, I was a bit surprised by this one.
Yeah, that tracks.
Consumer also had a notable day. A big deal worth $17 billion. And operational improvements, like Hershey cutting about $100 million of inventory. Sweet savings. Literally.
That one made for a fun headline, but it also reflected real focus on efficiency and scale in retail. Big transactions like that show capital is still chasing consolidation where margins can be defended.
Okay, quick reactions.
Right.
Now, pivoting to underperformers. Crypto and energy caused some of the day's stress. First, crypto. Bitcoin held above $76,500. But DeFi had a rough patch with a major exploit and liquidity stress at some protocols.
That split is important. Spot demand, driven by ETFs and institutional flows, helped keep Bitcoin steady. But on-chain protocol risks like exploits can wipe out liquidity in native DeFi instruments. So you had spot market resilience paired with real protocol fragility.
So separate the two if you're thinking about exposure. Custody-backed versus protocol-native.
Exactly. Analysts note that on-chain security events can create episodic drawdowns, even when the spot market looks firm.
Now, energy. Shipping disruptions near the Strait of Hormuz pushed oil higher and made the tape more nervous.
That's right. Short-term supply shocks like shipping closures can inflate oil and shipping costs quickly, which feeds into headline inflation worries and central bank commentary. It created two-way pressure. Short-term volatility versus longer-term decarbonization investments that remain intact.
Hold on, say that again?
I mean, when you step back and look at this, short-term shocks can temporarily push up inflation expectations, which matters for rate-sensitive sectors like real estate and utilities.
Let's move into a few of the most consequential moves today and why they mattered.
Go ahead.
SK Hynix mass production of that 192GB LPDDR5X module. We covered the basics, but to be explicit, this can accelerate upgrades in servers and edge compute and potentially reduce the number of nodes needed for big models. That's an upstream cue to watch.
Right. Watch memory utilization, foundry capacity, and OEM server bookings. Those are leading indicators for when enterprise spending may pick up materially.
Healthcare. Lilly's buyout and CAR-T prevention data. Those shortened timelines for commercialization in select pockets and gave the sector a near-term lift.
Investors often prize clarity on the path to cash flows. Positive readouts and strategic acquisitions do that, even though policy and pricing risk remain in the background.
Real estate had a headline takeover, $17 billion, and active financing flow. But commercial lending spreads were still a concern in pockets. That suggested a busy tape with differentiated outcomes.
Exactly. Large deals point to selective liquidity. But asset-level fundamentals, tenant quality, location, underwriting, will matter far more than broad sector momentum.
Materials saw a $120 million gold stream and other project moves, and industrials had more data availability, but execution lagged in many firms.
Industrial demand is becoming two-speed. Companies that convert data into measurable process changes will capture margin gains, while the others might lag.
Short reaction? Wow. Okay. Let's give listeners some actionable, informational insights. Not advice, just things to monitor. First, keep an eye on AI hardware supply signals, memory and foundry utilization, OEM bookings, and cloud CapEx commentary. Those tend to lead enterprise spending by 1 to 3 quarters.
Second, separate spot crypto exposure from protocol risk. Monitor ETF flows, custody announcements, and protocol audits. On-chain exploits can cause volatility, even when spot demand looks steady.
Third, watch geopolitical choke points and commodity reaction functions, shipping disruptions, Middle East developments, because they can quickly affect energy prices and inflation sentiment.
And fourth, regulatory calendars matter across tech, finance, and healthcare. Antitrust filings, stablecoin guidance, and drug pricing discussions can re-rate whole groups overnight.
Right. And finally, treat industrial and utilities AI projects as a two-speed market. Real ROI metrics are what separate pilots that scale from pilots that don't.
Companies that publish concrete reductions in cycle time or outages are the ones to watch for scalable gains.
Quick reaction. Interesting.
Yeah, that tracks.
Before we wrap, a short risk watch. Geopolitical shipping routes, inflation, and central bank commentary after commodity moves, regulatory surprises, crypto security events, and supply chain constraints for memory and power grid resilience.
Those are the headline items that could widen dispersion quickly. Analysts note, any of those can flip market leadership in a matter of days.
Final takeaways. 1. Secular growth narratives around AI infrastructure and event-driven healthcare continue to attract attention. 2. Crypto and energy reflected shorter-term volatility tied to security and geopolitics. 3. The next few weeks will likely be shaped by hardware supply signals, major regulatory milestones, and macro responses to energy shocks.
To sum up, momentum favored AI and health, but market leadership remained fragile because of geopolitics and regulatory risk. Keep watching the leading indicators we mentioned.
That's a great place to stop. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. See you next time.
Thanks, Ben. Take care, everyone. We'll have more after the next close.